Hello and welcome to the Certified Equity Professional Exam Overview webinar for the Equity Compensation Associate Exam, also known as Level 1 of the CEP exam. We provide these webinars to you to assist in your exam preparation process. This segment, which will focus on taxation, is being conducted by Andrea Kagan, CEP, who is one of our curriculum committee members on the tax panel. So on your exam, you will see that 30% of your questions are on tax topics. You'll have 4 hours to answer 110 questions. 100 of those questions will count towards your passing score. The other 10 are what we call experimental items, and those are just items we're test driving to see how they do on exams. Those are sprinkled throughout the exams. They're not identified, but that's why you'll have 110 questions. So this particular webinar will review the basics of how different equity types are taxed, and we'll spend a little bit of time on Section 6039 reporting also. We're not going to go over the basic attributes of each equity type except for the attributes required by the tax code. So if you want a more general overview first, particularly of grant types that are not tax qualified, I suggest that you listen to the administration segment of the webinars for this level before you listen to this one. So hey, Andrea, it's good to talk to you. Before we dive into taxation of the different kinds of equity compensation, what do people need to understand about how the money they make or lose is taxed in general?
Hi, Pam. I'm really happy to be here. In the most basic terms, there are two kinds of taxation we cover on the exams: compensation income and capital gain or loss. Compensation income is the same as wages or ordinary income. An example of compensation income is when a restricted stock grant vests. The amount the stock is worth on the vest date is income to the employee or to the participant that is treated from a tax standpoint the same as salary. The company has an obligation to report that income and, where applicable, withhold tax on it. When the company reports compensation for the employee, the company is generally entitled to a corporate tax deduction for the same amount that was reported. The second piece, the second kind of taxation that we cover, is capital gains and losses, which refer to the value or profit received from the sale of an asset, such as a share. As it applies to our discussion, capital gains and losses would apply to amounts outside the ordinary or compensation income amounts reportable by the company. For example, when an employee sells the shares of restricted stock we were just talking about, the employee will have a capital gain if the stock price has gone up since vesting, or a capital loss if the price has dropped. Capital gains and losses can be either short-term or long-term, depending on how long the asset or the share was held and whether or not it's been held for more than 1 year. The company does not receive a tax deduction for capital gains or losses attributable to employee transactions, and it has no reporting or withholding obligations with respect to capital gains or losses amounts.
Wait, so is the withholding exactly the same for equity compensation gains as it is for regular salary?
Sort of. As you'll see as we go along, nothing in equity compensation is ever completely straightforward. From a federal standpoint, income stemming from equity compensation is considered to be what's called supplemental income. Companies are required to withhold on ordinary income, such as we talked about on the last slide, paid to employees and former employees. The withholding rate for supplemental payments, such as income from equity compensation, is 22% for supplemental income amounts up to $1 million per year, and 37% for supplemental income amounts over $1 million per year. Companies can either withhold at those specific rates depending on the amount of supplemental gain, or they can aggregate the gain with the employee's regular salary for the period and withhold at the employee's W-4 rate. And of course, other federal taxes and state income taxes can come into play as well. FICA, which consists of Social Security taxes and Medicare taxes. There's an annual cap, an annual wage limit on Social Security tax, but not on Medicare. Additionally, the Medicare percentage will go up after a certain income level. FUTA taxes, which are unemployment taxes paid by the employer, which must match the amount of Social Security and Medicare paid by the employee. And state disability, SDI tax, varies by state. Many states do not collect state disability from the employees. And for those that do, SDI, state disability, is also subject to an annual maximum.
So you talked a little bit in the last section about how ordinary income and capital gains are measured. What other details about restricted stock do people need to know?
That's a great question, Pam. And first, we need to talk a bit about the difference between restricted stock awards and restricted stock units. The differences are subtle, but they affect tax treatment in some important ways. So it's very important to understand differences between restricted stock awards, RSAs, and restricted stock units, RSUs. First, we'll talk about restricted stock awards, RSAs. For these, the underlying shares are actually issued at the time of grant, so they are actual shares. They're held in escrow until vesting, but the employee does have shareholder rights, like voting rights and dividend rights, before vesting. Because of this, restricted stock awards, RSAs, are taxed under IRC, Internal Revenue Code, Section 83, and we'll talk about Section 83B elections, which you may have heard about, in a moment. Restricted stock units, RSUs, on the other hand, are not shares until they are released to the employees. So RSUs are converted to shares at the time of release, which for the purposes of the ECA exam is usually on the vest date. You should be aware that elections to defer receipt of payout are possible for RSUs, but not RSAs. We won't get into the details of deferral elections and Internal Revenue Code Section 409A until level 2.
So the employee recognizes compensation income at the vesting date equal to the full fair market value on that date for restricted stock?
Yes, usually. However, any amount the employee has paid for the stock is subtracted from that amount. For example, if the employee pays par value on an RSA, that's subtracted from the taxable amount.
So you talked earlier about withholding when restricted stock vests. So whose income does the company have to withhold on?
The company is required to withhold applicable taxes if the holder is a current or former employee. In that case, the income is reported on Form W-2. If the holder or participant is not an employee, then the income is reported on Form 1099 MISC, but the company does not withhold any taxes. The company still does get a corporate tax deduction, however, for ordinary income paid to non-employees, and an example of that would be outside directors. The fair market value that's used to calculate compensation income becomes the employee's cost basis. So when the shares are subsequently sold, any proceeds over what has already been included in the employee or former employee's W-2 or in the 1099 MISC, any proceeds over that are capital gains. The holding period for long-term capital gains starts when compensation income is recognized for federal tax purposes.
Okay, so now we saw something about a Section 83B election on an earlier slide. What is that?
That's a great question, Pam. It's an election that people holding RSAs can make that accelerates the compensation income to the grant date. So the tax point moves forward to the grant date. These are available for restricted stock awards and stock options, which we'll talk about shortly. These elections are not, however, allowed on RSUs. A restricted stock award holder who makes an 83B election is deciding to pay income taxes on the value of the shares on the date that the election is made, which then means there's no additional tax event at vesting. That's why it's called accelerating the compensation income. These elections do have a downside, however. If the stock price drops between the election date, when the employee elected to be taxed under 83B, and the date the shares vest, then the taxpayer does not get a refund. Whatever tax was paid at the date of grant under the 83B election, there's no refund available if the share price has dropped. The same is true if the recipient forfeits the shares. For example, because the person leaves the company before the vesting date. And about the 83B elections, it has to be filed with the IRS within 30 days of the exercise. The postmark constitutes the filing date and must include the items as listed on the slide you're seeing. You can find examples of the form all over the internet, but you don't even need a specific form. You can just put 83B election on a piece of paper, and as long as you have the information that's listed on the bullets on the slide, you're good to go.
So now let's move on to stock options, and let's start with the kind with fewer rules. So tell us about non-qualified stock options.
Sure. We'll start with non-qualified options, or NSOs, which are much simpler than incentive stock options, or ISOs. Unlike ISOs, NSOs don't have to comply with tax-related requirements, such as limitations on who can receive a grant, the term of the option, transferability, or the maximum number of shares available for grant. We'll talk about ISO requirements a little bit later. Non-qualified options, however, are not eligible for special tax benefits. The taxation of NSOs is somewhat similar to restricted stock, except that the tax event occurs on the exercise date, not on the vesting date, assuming the options are already vested on the exercise date, which is the case in the vast majority of instances. In this situation, optionees recognize ordinary income equal to the spread on the exercise date, meaning the stock price on the exercise date minus the exercise price. When those shares are sold, the optionee recognizes capital gain or capital loss equal to the difference between the sale price and the stock's fair market value on the exercise date. One side note, as we were talking about 83B, some non-qualified stock options, NSO grants, allow employees to exercise prior to vesting. In that case, the optionee can file a Section 83B election and pay income taxes on the spread at the exercise date, which can be 0 if the exercise comes shortly after grant.
And I see you brought us an example.
I did. Here's what it looks like. So you'll see there are different share prices at the different taxable points, at the different events in the life cycle of the option at grant, vest, exercise, and sale. And you should review this example with what you're reading in your reading materials.
Okay, so when the employee exercises, does the company have to withhold and report income the same way they do for restricted stock?
Yes, the company's obligations look a lot like what we talked about with restricted stock. The compensation income at the exercise date is subject to tax withholding if the optionee is an employee or former employee, and the company reports the income and withholding amounts on Form W-2. For non-employees, very similar to the RSAs, no withholding is required, but the income is reportable on Form 1099 MISC. When the company reports the compensation income, either on the W-2 or the 1099 MISC, the company is entitled to take a tax deduction for that amount, regardless of whether the optionee is an employee or non-employee service provider. Later, when the employee sells the shares, similar to the RSAs, the employer plays no role.
So now let's talk about incentive stock options. So what do we need to know about ISOs in the tax code?
When talking about ISOs, first we need to be familiar with IRC Code Section 422, because that's what governs them. ISOs can be eligible for favorable tax treatment, but for that to happen, they have to comply with all of the requirements of Internal Revenue Code Section 422. In general, there's no employer tax withholding upon exercise of an ISO, and companies receive a tax deduction for ISOs only if they are not held for the required holding period, which is what's known as a disqualifying disposition. It's important to know the tax code has stringent rules for ISOs, which we'll talk about on the next few slides, and you should be sure to be very familiar with.
Great. So first, can you talk a bit about what has to be in the plan document itself?
Yes, there are requirements which pertain to the plan. The plan itself has to be a written shareholder approved plan that specifies the number of shares that can be granted as ISOs and which employees or class of employees are eligible to receive them. In this context, employee really means employees. Sometimes we use the term employee generically to mean the person who gets an option or restricted stock, even though they could be a non-employee service provider. But in the case of ISOs, the optionee must be an actual employee of the company. The plan document that allows ISOs can allow for the grant of multiple kinds of equity compensation and grants to non-employees too, but must specify the maximum number of shares that can be granted as ISOs and ensure that ISOs are granted only to employees.
And then what are the rules for ISO grants themselves?
Lots of rules there too, including the option price for an ISO cannot be lower than the fair market value on the grant date. It can be higher and in fact must be at least 100% of the grant date fair market value if grants are made to anyone who owns more than 10% of the company's shares. The option must be granted within 10 years of the earlier of the date when the board adopts the plan or shareholders approve the plan. The term of an individual option cannot be longer than 10 years. This gets reduced to 5 years if the holder owns more than 10% of the company's shares. And another rule is the option can only be transferred if the employee dies and it is transferred to the estate. Otherwise, the option is non-transferable.
So now can we talk a little bit about the nitty-gritty of the employment requirement?
Can do. As I mentioned before, one of the major limitations of ISOs is that they may only be granted to employees. In order to remain eligible for the preferential tax treatment that we'll talk about in a minute, that employment requirement continues during the life of the incentive stock option. After an employee stops being an employee, he or she can have up to 3 months to exercise the ISO and still have it be considered ISO stock. At any later than the 3 months, the ISO is disqualified and treated as a non-qualified stock option, an NSO. In many cases, companies cancel options 3 months or less after termination anyway, but some don't. It's okay for the grant to allow exercise more than 3 months after termination. Just remember that the ISO status ends after 3 months. This also applies if an employee switches to consultant status and the options remain in effect. Any ISOs become non-qualified stock options, NSOs, 3 months after the end of employee status. If an employee becomes disabled, options may remain ISOs, as long as they were granted as ISOs, for up to 12 months after termination, assuming the expiration date of the option is not earlier than that. In the case of death, ISOs can be allowed to remain exercisable and still keep their ISO status until their original expiration date. Note that companies are free to set shorter limits. The tax code lays out how generous companies are allowed to be, but companies are not required to be that generous.
So other than staying employed, what else does the optionee have to do to be eligible for preferential tax treatment?
That's a great question, Pam, and we've got a graphic on the slide to help illustrate. The employee must hold the shares for a 2-prong time test, and both need to be met. The employee must hold the shares for a minimum of 2 years from the grant date and 1 year from the exercise date, as illustrated in the graphic on the slide. This shows the overlapping of the 1-year exercise period and the 2-year grant period. Note that the 2-year holding period is met on April 16th due to the date of the grant. However, because both prongs of this time test need to be met for qualifying tax treatment, the shares were exercised on May 12th, so they still need to be held for a year from May 12th in order to meet that holding period. So the first opportunity to sell with the preferential tax treatment would be after the 1-year holding period of May 12, 2019 to May 12, 2020. And add 1 day, because selling on the 1-year date will result in a disqualifying disposition after the employee did all that waiting. If both holding periods are met, the sale of shares is considered a qualifying disposition. If the holding period isn't met, the sale of shares is a disqualifying disposition. And we'll go into detail about what both of those mean in a moment. Also note, the employment requirement only applies until the ISOs are exercised. If the employee terminates after exercise and sells the shares 2 years later, that's still a qualifying disposition.
So what else do they need to know before we talk about qualifying and disqualifying disposition?
That's a great question, Pam, because there is one more very important limit around ISOs that we should discuss. That's the $100,000 limit, which says that no more than $100,000 worth of ISOs, and that $100,000 is valued based on fair market value on the grant date, no more than 100,000 can become exercisable in any 1 year. So let's look at an example of that. $100,000 is divided by fair market value on the grant date, because that's how it's valued, to arrive at the total number of shares that may be granted and become exercisable in that year. Exercisable generally means vest. Note that the amount used is the grant date fair market value, regardless of whether that's the exercise price. The exercise price, as we discussed, may be higher than the fair market value, but the fair market value is still used for this $100,000 calculation. Let's say fair market value on the grant date was $10. So the $100,000 limit divided by a $10 fair market value is 10,000 shares. If you were granting shares that would all be exercisable in that calendar year, and you were granting only 5,000 shares, you're under the limit, which was 10,000, and you still have some leeway for granting more ISOs that will vest in that same year. Exceeding the limit of the 100,000 doesn't disqualify the whole grant as an ISO, but any shares granted in excess of the $100,000 limit are treated as non-qualifying stock options, including the option that puts the grant over the limit. You can also do the same calculation reflecting dollars instead of shares, and this is better when dealing with overlapping awards. Let's look at some examples. In this example, the shares vest. So if we go back to what we talked about previously, there were 10,000 shares at a $10 fair market value price. In this example, shares vest $2,500 per year over 4 years. Since they vest annually, there's no calculation for the year of grant. Starting at the end of year 1, the first 2,500 shares vest, and the value is $37,500 based on grant date fair market value of 15. So this example is slightly different than the last one. Fair market value is $15, so $15 per share times the 2,500 shares that vested in year 1 is $37,500. So subtracting $37,000 from the $100,000 limit for the first year leaves $62,500 for that year, year 1. Since no more shares will vest in that year, there's no issue. We are under the $100,000 limit. Each year is the same, you'll see, with leftovers. But it is rare that you would have only one award with one tranche vesting in a year. So let's layer on another award and see what happens.
So how does it work if you've got multiple ISO grants vesting in a year and that puts them over the limit?
When that happens, as we mentioned before, the options over the $100,000 limit are disqualified and taxed like non-qualified stock options, NSOs. If the person has multiple grants, the options are taken in the order they were granted when calculating the limit. So looking at this example, it adds another grant to the one on the previous slide. This shows the amount vesting in a single year. In addition to the grant from the previous slide, the 2,500 shares vesting, the person was later granted 1,500 options meant to be ISOs. You'll recall from the previous slide, the original grant reduced the limit only by $37,500, so there's still $62,500 left that year in the $100,000 limit. The 1,500 shares have a total grant date value, again, going fair market value on the date of grant. For the second grant, it was $50. So the 1,500 shares have a total grant date value of $75,000, which puts them over the remaining limit. The remaining limit was $62,500, puts them over that limit by $12,500. The original grant remains all ISOs, but the second grant of 1,500 is only partially ISOs, as shown here.
So now that we understand the grant and plan limits, are we ready for how ISOs are taxed?
We sure are. It's time to explain what we mean when we refer to qualifying and disqualifying or non-qualifying dispositions. The first thing to know is that a properly granted ISO, there's no tax consequence to the employee, either at the time of grant or at the time of exercise. But it's important to note that the spread on the exercise date is considered a preference item that's subject to alternative minimum tax AMT requirements if the employee holds the shares through the end of that calendar year. So regular tax is not due at exercise. There's no employer reporting. There's no employer withholding when ISOs are exercised. But it's important that the employee know that he or she may owe alternative minimum tax for that year if his or her income is high enough. When the employee sells shares, if it's a qualifying disposition, which means the employee has satisfied both of those holding requirements that we talked about a few slides ago, then all of the gain is long-term. That's the entire gain between the grant price and the sale price of the shares. There's no ordinary income involved at all. If the sale is a disqualifying disposition, meaning that one or both of the holding period requirements are not met, the ISO taxation will end up looking a lot like an NSO. The spread on exercise will be taxed as ordinary income, although the tax treatment occurs in the year of sale, not in the year of exercise. So the employee still does benefit from a deferral of the tax point, but there is ordinary income as well as capital gain or loss, which would be any change in the fair market value between the exercise date and the sale date. As for the company, because there's no tax consequence to the employee at the time of exercise, there's no withholding. We did talk about alternative minimum tax potentially at the time of exercise, but that is not something that the company is involved with. That's only for the employee. And because there's no regular tax consequence to the employee at the time of exercise, there's no company withholding. At the sale date, if the sale is a disqualifying disposition, there's ordinary income, and the company is required to report ordinary income on the W-2, but there's no withholding. If the sale is a qualifying disposition, there's no W-2 income, so there's nothing for the company to report or withhold. The company can take a corporate tax deduction for ordinary income amounts reported on the W-2 in connection with a disqualifying disposition.
And so now can you walk us through the math a little bit?
I can. First, we'll look at a qualifying disposition. You'll see the grant price is 10, and vesting price is 15, but that doesn't mean anything because there's no income at vesting. There's no tax event at vesting. The ISO is exercised when the share price is $30. That $20 difference between the exercise price and fair market value on the exercise date, as we talked about, is not taxable for ordinary income purposes, but is a tax preference item for the alternative minimum tax calculation for that calendar year. In this example, the person sells the shares for $50 after the holding period has expired, and the entire $40 spread is long-term capital gain, because you'll see that this is a qualifying disposition.
So what does that look like if it's a disqualifying disposition with the same prices?
In that case, since either one or both of the holding periods are not met, the $40 difference between the grant price and the sale price is broken into two pieces. The $20 spread at exercise is compensation income, but again, it's deferred until the time of sale of the shares. The capital gain element is the difference between the $30 fair market value at exercise and the $50 sale price, so $20 a share. The gain is short-term if the sale is less than a year from exercise, or long-term if it's been more than a year since exercise, but less than 2 years from grant.
Okay, so now let's move on to our other kind of tax qualified plan, Section 423 Employee Stock Purchase Plans.
So, like it sounds, ESPPs can be tax qualified under Section 423, which is just next door to Section 422 that we were talking about for ISOs. There are some similarities with ISOs, but there are some important differences. If a company has a Section 423 ESPP, participants enroll and elect amounts to contribute from each paycheck, which means they aren't discretionary in the same way that stock option grants are. And just like there were rules under IRC Section 422 for incentive stock options, to qualify under Section 423, plans must meet specific rules. There's shareholder approval. ESPP must be approved by shareholders within 12 months before or after board adoption. Participation. Almost all employees must be allowed to participate, with exceptions for employees who typically work less than 20 hours a week, employees with less than 2 years of service, employees who regularly work for fewer than 5 months in a calendar year, and highly compensated employees. In these cases, a company can be more generous. For example, it could allow people to enroll after 6 months of employment instead of making them wait for 2 years. But those plan limits must be applied equally to everyone. And the participation allows for exclusion, but it doesn't mean the plan has to exclude those groups. It just allows for the ability for the company to exclude if the company chooses to do that.
So what else do they need to know about ESPPs?
When shares are purchased under the plan, the purchase price is often based on the lower of the stock's fair market value of the first day of the offering period or the purchase date, which is called a look-back provision. Under Section 423, the purchase price cannot be any lower than 85% of the fair market value on one of those two dates, the first day of the offering period or the purchase date, whichever is lower. An ESPP that's qualified under Section 423 can't have an offering period longer than 27 months unless the purchase price is based solely on the ending FMV, in which case the offering period can be as long as 5 years. ESPPs are non-transferable, and here's one of those similarities to ISOs. There is an IRS limitation of $25,000 on the value of stock that can be purchased in a year. So ISOs had a limitation. Section 423 ESPPs have a value limitation, and we'll look at that on the next slide.
So is it just that the employee can't pay more than $25,000 for ESPP stock in a calendar year?
No, that would be simpler, but that's not how the limit works. It is measured based on the stock's fair market value on the first day of the offering period, regardless of whether or not that's the actual purchase price. So if an offering period starts when fair market value is 10 and the plan has a 15% discount and a look back, the employee can purchase a maximum of 2,500 shares in that calendar year, regardless of whether the stock price goes up or down during that offering period. And that's because the $25,000 limit is measured based on the stock's fair market value on the first day of the offering period. In this example, fair market value is 10, so 25,000 divided by 10 means the 2,500 shares that an employee can purchase in that calendar year. It's also based on the right to participate over the course of the year, not just the purchase in a calendar year. So a participant could have the right to buy more than $25,000 worth of stock in a single offering period if the offering period extended over multiple calendar years.
So now that we understand the limits, what's the tax treatment of ESPP shares?
To look at the tax treatment, we need to return to the idea of a holding period like we talked about with ISOs. Section 423 plan shares have a holding period similar to ISO shares. In the case of ESPPs, however, the 2-year holding period begins at the start of the offering period, and the 1-year holding period begins on the purchase date. The sale of shares within either of those periods is a disqualifying disposition. Participants in Section 423 ESPPs don't recognize any income at enrollment when they choose to participate or when they purchase shares. There is a compensation element on the sale date, even if the shares are sold in a qualifying disposition. The tax treatment of the disqualifying and qualifying dispositions is a little tricky though, as we'll see in examples on the next 2 slides. Unlike ISOs, there is some ordinary income when Section 423 ESPP shares are sold in a qualifying disposition. The amount of the compensation income is the smaller of the actual gain on the shares or the purchase price discount determined using the stock's price on the grant date, even if that's when the stock's actual purchase price is set. Again, the compensation income from a qualifying disposition is reportable by the employer on the W-2. Any additional profit is capital gain. So if we look at the slide, which is talking about a qualifying disposition, fair market value on first day of the offering period is 10. Fair market value on the purchase date is 14. The purchase price this has a look back, so it's the lower of the two, and it has a 15% discount. So the purchase price was $8.50, and the sale price of the shares was $20. So in this case, the ordinary income was the purchase price discount, and the capital gain is the sale price minus the fair market value on the offering date.
So how would that look different if it were a qualifying disposition?
So in a disqualifying disposition, you will see, if you look at taxable amounts, the ordinary income you can see immediately is higher. And that's because the compensation income in a disqualifying disposition is the difference between the stock's fair market value and the purchase price on the date of purchase. So the discount at purchase. So where there was $1.50 in ordinary income on the previous slide in the qualifying disposition, the disqualifying disposition has a much higher ordinary income amount, and the capital gain is smaller. So the income for a disqualifying disposition has been reallocated between ordinary income, there's more ordinary income, and less capital gain.
And does the employer have any withholding or reporting obligations?
There are some, but not as much as for grants that are not tax qualified. The company must report the ordinary income, which will occur in either a qualifying or a disqualifying disposition on the employee's Form W-2. However, the company only gets a corresponding tax deduction for a disqualifying disposition, not a qualified one. And similar to ISOs, the company is not required to withhold taxes in either case. So the company is reporting, but the company is not withholding. There's also an information reporting requirement under Section 6039 at the time of purchase, but we'll talk about that a bit later.
So do ESPPs have to be tax qualified?
No, they do not. Non-qualified ESPPs aren't as common as the tax qualified Section 423 plans, but they do exist and they allow for more design flexibility. They can, for example, be offered to non-employees or offer a discount greater than 15%. For these ESPPs, the taxation is similar to taxation of non-qualified stock options. The participant owes ordinary income taxes on the discount at the purchase date. Then when the participant sells the shares, the difference between the purchase date fair market value and the sale price is capital gain or loss. The company can take a tax deduction for the amount the employee must claim as ordinary income. The company does have reporting and tax withholding obligations at the date of purchase for non-qualified ESPPs. I know candidates have read some tax code section 419A, which governs deferred compensation, as you've studied for the ECA exam. You aren't tested on it until level 2, but I want to address at least one 409A related topic here. In most cases, purchase price discounts on stock options lead to taxes and penalties under section 409A. But there's an exception for purchases that occur on a set date. Since non-qualified ESPPs have set offering periods, just like section 423 tax qualified ESPPs, they comply with section 409A.
So you mentioned there's an additional reporting requirement for ESPPs. What is that?
It's reporting that's required under Section 6039, and it actually applies to both incentive stock options and ESPPs. Section 6039 requires companies to, 1, provide optionees and ESPP participants with information that should be helpful in determining their taxes, and 2, provide the IRS with that same information. The reports are required after the corporation, 1, issue shares to an individual or exercises an ISO, or 2, transfers legal title of shares of stock acquired at a discount under an ESPP. The regulations under 6039 apply to both private and public corporations, although relatively few private companies have ESPPs. The ESPP requirement is for a report upon first transfer, which is defined to include the deposit of shares into the participant's brokerage account. By contrast, the issuance of a stock certificate directly to an employee or the registration of stock ownership on the employer's books and the holding of shares in book entry form is not considered the first transfer of legal title of the stock acquired by the employee, and no return or information statement under Section 6039 is required to be filed or furnished until later when legal transfer occurs. Companies' statements to participants. Companies must provide statements to persons who exercise ISOs or bought shares under an ESPP regarding number of shares purchased, purchase or exercise price, and value of shares transferred, among other specifics.
So now let's move on to some special circumstances where the tax rules are different than usual. So you said ISOs can be transferred if the optionee dies. What's the tax treatment when that happens?
First of all, transfer to the estate is not a disqualifying disposition, regardless of whether it's unexercised ISOs or ISO stock transferred to the estate. Furthermore, the estate isn't subject to holding periods. The executor could exercise ISOs and sell the stock on the same day, and it would still be a qualifying disposition. The estate may also be allowed to exercise the options anytime before the option's expiration date. There's no 3-month post-termination exercise period in this case. If shares are exercised prior to death, the transfer of the shares is not a disposition, and the ISO holding periods do not apply. If the ISOs are exercised after the employee's death, the estate receives a stepped-up basis in the stock equal to the exercise price plus the fair market value of the option at the date of death. That fair value must be measured using an option pricing model such as Black-Scholes. And please be aware, AMT may apply to the estate.
And how do leaves of absence or terminations due to disability affect tax-qualified grants?
In the case of a leave of absence, the regulations provide that the employment relationship will terminate for purposes of the option after 3 months of leave, unless the individual has a right to continued employment with the company under either contract or statute, such as the Family and Medical Leave Act or Uniformed Services Employment and Reemployment Rights Act of 1994. For ESPP participation, the employee retains the right to participate as long as the leave isn't longer than 3 months or if the ability to return to work is guaranteed. However, from a practical standpoint, if the leave is unpaid, there won't be any payroll deductions during the leave. After 3 months of unprotected leave, the employee is regarded as terminated for the purposes of maintaining tax qualified status. At that point, the 3-month post-termination period begins. So functionally, it is possible for an ISO to remain an ISO for 6 months after the person's last day at work. If the employee terminates due to disability, unexercised ISOs can remain tax qualified for up to 1 year.
Well, thank you very much, Andrea. That was very helpful. So for candidates who are interested in additional courses that could help in your exam preparation, we've listed a couple options on this slide. The exam overview webinar is provided to help you in your exam preparation, but I just want to give the disclaimer that the webinar is not in and of itself sufficient exam preparation, and all of the questions that you will see on your test are developed exclusively from the textbooks that you've been assigned to read. So this webinar and the others on the other domains are going to be available to you right up until the exam date, so you can listen to them as many times as you want if you find them helpful. And good luck on the test, everyone.